Hello everybody, myself Dr. Amrita Sahu, Associate Professor from the Department of Commerce, the Bhopal School of Social Sciences. Today we are going to start with the corporate accounting. This is the main paper of BCom Honours second year. We are going to start with the meaning of corporate accounting. What is a company? What are the shares? What are the types of share? What is the share capital? And various terms related with the shares. Meaning of corporate accounting. What is corporate accounting? Corporate accounting refers to the measurement, recording and financial statement of a limited company, whether it is a public company or a joint stock company. Now we'll come to the what is company. According to the section 2 subsection 20 of the Companies Act 2013, a company means a company incorporated under any of the previous act or of the company law 2013. According to the Professor Hannay, a company is an artificial person created by law having a separate entity and a common seal. Now we come to the meaning of share capital. Share capital means the fund raised by the company by issue of shares is known as the share capital. According to section 43 of the Companies Act 2013, share capital is of two types. First one is the preference shares and second one is the equity shares. Preference share capital, here we have the two conditions to be fulfilled. Well, first condition, as the name indicates, these are the preference ones. So preference shares have the preferential right to get the fixed rate of dividend or the fixed amount of dividend before the equity shareholders. And second condition should be fulfilled, that at the time of winding up, the preference share holders should get the money back before the equity share capital. Now we come to the equity share capital. Equity share capital are those capital which are not preferential, which means that they will not get the rate of dividend at a fixed rate or before the preference shares, or at the time of winding up they will not get the money before the preference share capital holders. Now we move to the classification of share capital for the purpose of accounting. Now the first one is the authorized capital. Now what is authorized capital? The capital with which the company started the business, that is known as the authorized capital. It is also known as the nominal capital or the registered capital, which means initially when the company started the business, that is known as the authorized capital. Now after that we are having the issued capital and the unissued capital. First of all, we'll move to the issued capital. Issued capital, that is the part of the authorized capital. Next one is the unissued capital. Unissued capital is that which is not issued by the company, that is also a part of the authorized capital. Next is the subscribed capital and the unsubscribed capital. Subscribed capital is that capital which is subscribed by the public, that is a part of the issued capital. And unsubscribed capital is those capital which is not taken by the, that is a part of the issued capital not subscribed by the public. Next is the called up capital. Called up capital are those capital which is a part of the subscribed capital called by the company for raising the fund. Next one is the uncalled capital, that is also the part of the subscribed capital which is not called by the company. Generally, company call the amount of shares in the parts or in installment. So that installment can be covered under the called up capital and uncalled capital. Next one is the paid up capital. Paid up capital is the part of the called up capital which is paid by the public on the call made by the company. And apart from this, we are also having the unpaid capital. The amount of called up capital which is not paid by the public, that is known as the unpaid capital. Apart from this, we are also having the reserve capital. Reserve capital is the part of the uncalled capital. This capital is being kept by the company and called by the company at the time of winding up. Classification of share capital can be explained with the help of an example. First of all, I told you that authorized capital is the capital with which the company started the business, or it is also known as the registered capital or nominal capital. For example, suppose company started the business with rupees 10 lakh, means 1 lakh shares at the rate of 10 each. Now this 10 rupee can be called by the company in the form of installment. Now this 10 rupee is can be called by the company in the form of 2 rupee in the form of application money, 2 rupee in the form of allotment money, 3 rupee in the form of call money, first call, or 3 in the second call. Now this is the classification of the authorized capital. Authorized capital is 10 lakh rupees. 1 lakh shares, this is divided into 1 lakh shares. As I told you, share is a part of a capital of a company. So this 10 lakh is divided into 1 lakh shares of 10 rupee each. Now the company will issue the part, this is the authorized capital. Now after that, the company will issue the part of the capital. So this is known as the issued capital. Suppose out of this 1 lakh rupees, 1 lakh shares, company has issued 20,000 shares. So this 20,000 shares, on that when the company call the money, this will become the issued capital. And whatever is not called by the company, this is the unissued capital. So here 80,000 shares at the rate of 10 is the unissued capital. Here 20,000 shares at the rate of 10 is your issued capital. Next we are having the classification as the subscribed capital and the unsubscribed capital. Subscribed capital, suppose out of this 20,000 shares, public has subscribed 10,000 shares. So this 10,000 is your subscribed capital. And whatever the 10,000 is left, this is your unsubscribed capital. Further, we are having the classification as the called up capital and the paid up capital. Called up capital, here out of this 10,000, as we have the classification of this 10 rupee, that is 2 rupees, 2 rupees, 3 rupees and 3 rupees. This is called by the company in installment. So out of this 10 rupee on 10,000 shares, suppose company has called these 4 rupees of the application money and the allotment money. So here this 4 rupee, that is at the rate of 4, on that we are having 10,000 shares. So 40,000 is your called up money, and remaining 6 rupee, that is at the rate of 10, 60,000, that is uncalled money. After that, we are having the classification of paid up capital and unpaid capital. Suppose out of this 4 rupees, public has given only 2 rupees on application at the rate of 2. So here on 10,000 shares, 20,000 is the amount of paid up capital, and remaining 20,000 is the unpaid capital. Now we are also having the reserve capital. Reserve capital is the part of the, that is the 60,000 is the reserve capital which is kept by the company for further use. This Reserve capital is called by the company at the time of winding up when they further need the funds. Now we will move to the meaning of a shares. In simple words, if you want to understand the share is a small unit of a capital, means the capital of a company divided into small units, that is known as the shares. Now shares are of two types. Shares are preferential as well as equity. As we have already understand the share capital also of the two types, equity shares and the preference shares. In the same manner, shares are also of the two types, that is preference shares and the equity shares. Here also we have the two conditions to be fulfilled, that is preference shareholders should get the preferential right before the equity shares for getting the dividend, as well as they will get the money back before the equity at the time of winding up. Now we'll move to the types of preference shares. Preference shares are further classified into four categories. First category, on the basis of areas of dividend. It means preference shares are of cumulative preference shares and the non-cumulative preference shares. Now what is cumulative preference shares? Cumulative preference shares, as the name indicates, that those shares have, if the suppose company is having any kind of loss in a few years, so particular year dividend is not paid by the company. In that situation, that dividend amount is going to be transferred or accumulated to the next year. Suppose in the next year also company faces the loss, then again the company is unable to pay the dividend, then in that case again this accumulation of the dividend is going to be transferred to the next year. Suppose in any year company faces the losses and this year they are unable to pay the dividend, then in that situation company is going to pay the dividend in the next year. So accumulation of dividend will be taking place. Further, the company in the year when the company get the profit, the company will pay the dividend of the current year as well as of the past year accumulated dividend is paid by the company. Next one is the non-cumulative preference shares. Non-cumulative, as the name indicates, that these preference shares will not get any kind of accumulated dividend. If the company faces loss, the company will not pay the dividend. If the company gets the profit, the company will pay the dividend to these preference shareholders. Further, we are having the classification on the basis of rights of profit. Here we are having the participating preference shares and non-participating preference shares. As we are knowing that preference shares are having the preferential right for getting the dividend before the equity, so definitely they will get the fixed rate of dividend or the fixed amount of dividend before the equity shareholders, and then the equity shareholders will get the dividend. After that also, after making the payment to the equity shares, if suppose the company is having more amount of profit with them or they are having the surplus amount of profit with them, then in that case the participating preference shareholders will get the right of dividend in that extra profit. So what is participating? Means the participating preference shares will get the extra profit in the surplus amount of the dividend. And on the other hand, we are having the non-participating preference shares. Non-participating preference shares will not get any kind of surplus profit in that extra profit. So this is a classification on the basis of right of profits. Next we are having the on the basis of convertibility. Now as indicates conversion of the shares. Preference shares can also be converted into equity shares, and these are known as the convertible preference shares. On the other hand, we are having the non-convertible preference shares. Those shares are not easily converted into the equity share. This is known as the non-convertible preference shares. Again, we are having the further classification on the basis of redemption. On the basis of redemption, preference shares are again classified into two categories: redeemable preference shares and non-redeemable preference shares. Redeemable preference shares are those preference shares, those are redeemed means they are getting their money back at the time of winding up. And next one is the irredeemable preference shares, those which are not getting the money or redeem at the time of winding up. Now for all this category, the company should mention this in the articles of a company when they are issuing these shares. What is the category of preference shares? What are the number of preference shares? That should be mentioned before the issue of the shares in the articles of the company. Now various terms related with the shares of a company. First one is the private placement of shares. Now first, according to the section 42 of the Companies Act 2013, private placement of share means the amount of share which is not issued for the public but is issued to the some private institutions or investors for this purpose, like the UTI, we are having the life insurance corporation or the banks. Next one is the sweat equity shares. According to section 2 subsection 88 of the Companies Act 2013, sweat equity shares are those shares which are issued by the company to their employees or the director of a company at a discounted rate for the technical know-how or for the making the intellectual property rights. Next one is the initial public offer. According to section 23 of the Companies Act 2013, initial public offer means the offer which is made specially for the public for getting the fund or raising the fund from the public sources. Next one is the right shares. As per the section 62 subsection 1 of the Companies Act 2013, right shares issue are those shares which are issued to the existing shareholders as according to their holding which they are having. The object of issuing the right share is to make sure that there is a equitable distribution of shares among the shareholders apart from the fresh issue. For issuing all those type of categories of shares, the company has to pass a special resolution in the general meeting of a company, and then only they can issue these kind of shares. Next one is the bonus shares. According to the section 63 of the Companies Act 2013, bonus shares are those shares which are issued by the company apart from the money. Means whenever the company is having the fund but they don't want to give in this amount in the cash form of dividend, then in that situation these are going to be issued in the form of shares. So instead of giving the extra dividend in the form of money, they give the money in the form of shares. This is known as the bonus shares. For all this category of the shares, company has to pass a special resolution in the general meeting, and then only they can decide what is the number of shares and what kind of share they are issuing to the raising the funds. So this is the theoretical introduction about the corporate accounting, company, shares and its types. Now in the next module we will start with the practical approach of this chapter. Thank you.